Hi, this video is about adjusting entries. In Accounting 1 for sole proprietorships, the focus is on two accounts that we adjust, and that is the supplies account and the prepaid insurance account. So when I teach this section, I usually teach the entire worksheet, preparing the worksheet first, and then on a separate day, I explain adjusting entries. The worksheet section tends to be a little challenging because it's just kind of so much in there for students to get. So I typically teach how to create a worksheet first, and then I go back and explain the whole concept of adjusting entries. So adjusting entries in the Southwest Edition 10 textbook is on page 176 and 177. All right, so this is how I start this concept. So for adjusting entries, there are two accounts that we adjust. We adjust the supplies account and we adjust prepaid insurance. So I always make sure the students understand that those are the two accounts that we adjust. And the journal entry for both of those accounts stayed the same. But what they must learn is the amount that goes into the journal entry. Okay? So the journal entry to adjust the supplies account is always debit supplies expense, credit supplies. The journal entry is always debit supplies expense, credit supplies. The journal entry for prepaid insurance, debit insurance expense, credit prepaid insurance. This is always a journal entry. We always debit supplies expense, credit supplies, debit insurance expense, credit prepaid insurance. But the question is, why? Why do we do these adjustments? So I typically start with a little story because I like to tell stories. They give me a visual, they help me connect, and it seems to work well for my students. So here we go. So imagine I have started a shoe company. I decided I want to sell shoes. I love shoes. I go to a warehouse, I buy a bunch of shoes, I put the shoes in my house. Boom. I'm a sole proprietor who sells shoes. I have my own shoe company now, Miss Showalter Shoes. So that's where we start. So when I decided to start my shoe company, I had to go out and buy shoes. Let's say I paid cash for all my shoes. So when I bought these shoes, I did a debit to supplies and I did a credit for cash to buy my shoes. So let's say I paid $1 for every shoe. So I paid $1 for every shoe and I bought 100 pair of shoes. That means I spent $100 on my shoes. So this journal entry would be $100 to represent the purchase of my shoes. And the value of the shoes that I purchased is $100. Okay, so that's buying the shoes. So now I'm in business. So next I need to sell my shoes. So let's say I only take cash okay? And I sell my shoes for $10 each. So I am selling my shoes. So I'm selling my shoes for $10 each, okay? So I usually call out the students. So, Susie came in. She loved my shoes. She bought 3 pair of my shoes. And I'm like, how much did Susie spend? And everyone's like, $30. So Susie spent $30 for my shoes. So the journal entry for Susie buying shoes would be a debit to cash and a credit to sales for $30. Susie bought 3 pair of shoes, $10 each. That's $30. So now I have $30 in cash and $30 in sales. The focus here is to help the students see that when I sell my shoes, it does not affect my supplies account. So I bought my shoes, and let's say I'm keeping them in the garage in my house. So I go to my garage. I started out with 100 pair of shoes. I've already sold 3 pair. So now I only have 97 pairs of shoes left. Okay. So let's say, I keep going and I sold some more shoes. Somebody's like, these shoes are awesome. I love them so much. I want to buy 20 pairs of shoes. Let's make it 27. We're going to go whole. 27 pairs of shoes. Okay. So once again, the journal entry is debit, cash, credit, sales. 27 pairs of shoes. That is $270. $270 because I'm selling my shoes for $10 each. So once again, I have moved quite a bit of my shoes. Remember, I started out with my shoes. When I bought them, I had 100 pair, okay? And now I have sold 30 pair of shoes. So if I had started out with 100, I bought 100, sold 30, that leaves 70 pair of shoes, okay? This is how much I still have, 70 pair of shoes. 70 pair of shoes equal $70 worth of shoes on hand, okay? So that means if I go to my garage where I keep all my shoes and I go out and count up my shoes, I can touch them. They're on my hand because I can touch them. I have $70 worth of shoes because remember, I bought the shoes for $1 each, which means I spent $100. I'm selling the shoes for $10 each. But when I sell shoes, it has no impact on my supplies. This is what leads us to our adjusting entry. So at the end of the month, we must adjust the supplies account to reflect the amount of shoes that we actually still possess, that we have not sold. So that's where the on hand amount comes from. Okay, so that's where the on hand amount comes from. So if I sold it, then it's no longer in my garage. It's no longer where I can touch it. It's no longer on hand. Okay, so we must make the supplies account reflect what actually still exists. So right now the supplies account has $100 in it, but it really needs to have $70 in it. So we have to make that adjustment. So that's what we must do. So the amount of supplies comes from the general ledger. So we would go to the general ledger to find out the amount we have in our supply account. Then we go to the on-hand amount. This amount has to be given to you in the problem. There's no calculation. You won't have to figure it out. It has to be given to you in the problem. It has to say, we have, $70 on hand or whatever, but that must be given to you in the problem. Okay. So when I have what I originally started with and what's left, the difference is $30. So supplies account from the general ledger is $100. The on hand amount is $70. The difference is $30. This is the adjusting amount. Okay? So this will be the adjusting amount. So when I go back down to my journal entry, debit supplies expense, credit supplies, the amount that will go here is $30. Okay? So that is how we do the supplies adjustment. So the focus is that we are always adjusting down. We're always adjusting down. Okay? So that is the supplies adjustment. That's the supplies adjustment.